When we talk about a country's economy, we're really talking about the total value of everything it produces and sells, measured by gross domestic product or GDP. GDP is like a giant scoreboard, showing how much value a nation creates through goods and services over a certain period. It's a key indicator of a country's overall economic health and well-being. When GDP grows, it means more jobs, higher wages, and a sense of prosperity. People feel more confident about their future, and businesses are more likely to invest and hire new workers. The positive momentum can be felt in everyday life, from busy shops to new construction projects. Businesses expand, people spend, and the government collects more taxes for public services. This cycle helps fund schools, hospitals, and infrastructure, making life better for everyone. But sometimes, this engine slows down. The energy that once fueled growth starts to fade, and the signs of slowdown become visible in daily life. When an economy shrinks, the total value of goods and services drops. Shops may close, factories might reduce output, and the overall mood can shift from optimism to caution. This can be triggered by lower demand, cautious consumers, or businesses holding back on investment. Sometimes global events or political uncertainty can also play a role, making people and companies more hesitant to spend. A shrinking economy often leads to job losses, stagnant wages, and uncertainty. People may worry about their job security, and families might cut back on spending, creating a ripple effect throughout the economy. Imagine a bakery selling fewer loaves. Now multiply that across thousands of businesses nationwide. That's what a national economic contraction looks like. Every small change adds up, affecting communities and livelihoods across the country. For Germany, known for its industrial might and global trade, a shrinking economy is big news. The effects can ripple out to factories, ports, and the many industries that rely on exports and international partnerships. It raises concerns not just for Germans, but for trading partners and the broader European economy. When Germany slows down, it can impact jobs and growth in neighboring countries as well. The reasons behind such downturns are complex, involving both domestic and international pressures. Factors like energy prices, global demand, and political decisions all play a part in shaping the economic landscape. Understanding this is crucial, because a country's economic health affects everyone within its borders, and often, people beyond them. The choices made today can shape opportunities for future generations. In the next scenes, we'll explore what's driving Germany's current contraction and what it could mean for the future of Europe and the world. Germany's Federal Statistics Office just confirmed the economy shrank by 0.3% in the second quarter of 2025. That may sound small, but for a major economy it's a serious setback, especially since earlier estimates predicted only a 0.1% dip. The revision came as more data revealed weaker industrial production and investment than expected. This isn't an isolated blip. Germany was the only G7 nation not to grow in 2023 and 2024, and now faces a possible third year of stagnation or recession. For every 1,000 euros of economic activity in Q1, there were only 997 euros in Q2. Multiplied across trillions, that's a huge loss. This contraction hits corporate profits, government revenues, and household security. It's a clear signal. Germany, once Europe's economic engine, is facing real headwinds. The question now is, what's behind this downturn? Let's look at the key factors. One major culprit: U.S. trade policy, which has been a significant factor in the economic relationship between the two nations. In April 2025, the U.S. slapped a 10% tariff on a wide range of imports, including German goods. This move was part of a broader strategy to protect American industries and reduce the trade deficit. For Germany, whose economy relies heavily on exports, this was a major blow. The country's economic health is intricately tied to its ability to sell goods abroad. Suddenly, German cars, machinery, and chemicals became 10% more expensive for American buyers. This price hike made German products less competitive in the U.S. market. U.S. companies and consumers started looking elsewhere, and demand for German products dropped. This shift in purchasing behavior had immediate effects on German businesses. In 2024, trade between the two nations was worth 253 billion, so even a small dip is significant. The interconnectedness of the global economy means that changes in one area can have widespread repercussions. Official stats show German exports fell 0.1% in Q2, a red flag for an export-driven economy. This decline, though seemingly small, is a warning sign of larger issues. The tariff forced German businesses to either absorb the cost or pass it on, hurting profits or sales. Many companies found themselves in a difficult position, having to make tough decisions. This shows how a policy decision in Washington can ripple through German factories and the entire economy. The interconnected nature of global trade means that no country is isolated from such impacts. The export slowdown was the primary driver of Germany's contraction, exposing the vulnerability of its export machine. This situation underscores the risks inherent in a globalized economy. In a globalized world, no economy is immune to international shocks. The ripple effects of policy changes can be felt far and wide, and for Germany, the US tariff wall hit right at the heart of its economic model. The impact of these tariffs serves as a stark reminder of the delicate balance in international trade. When uncertainty rises, investment is often the first casualty. In Q2 2025, German businesses pulled back sharply, with investment dropping 1.4%. Companies delayed buying new machinery, upgrading technology, or expanding facilities. For example, car makers postponed new assembly lines and chemical firms shelved research labs. This collective hesitation ripples through the economy, slowing growth even further. The US tariffs made future sales uncertain, so why invest in more capacity? Lower investment today means less productivity and competitiveness tomorrow. It's a vicious cycle. Less investment leads to slower growth, which makes businesses even more cautious. The 1.4% drop isn't just a blip, it's a warning sign for Germany's future. If companies don't innovate or expand, they risk falling behind global competitors. The investment freeze is a clear symptom of an economy losing confidence. While exports and investment faltered, German consumers barely budged. Household spending rose just 0.1%. This tiny increase shows that, despite economic uncertainty, people are holding onto their wallets, choosing to save rather than spend on non-essentials. The mood on the streets is cautious, with many Germans worried about the future and reluctant to make big purchases. People kept buying essentials, but weren't splurging, reflecting caution. Supermarkets and local markets saw steady business, but luxury stores and restaurants felt the pinch as consumers prioritized necessities over treats or upgrades. Government spending, however, rose 0.8%, as Berlin tried to stabilize the economy with infrastructure and public service investments. Projects to repair roads, upgrade public transport, and support healthcare were ramped up, aiming to create jobs and keep the economy moving. But even this boost couldn't offset the drag from weak exports and investment. The extra government spending was not enough to fill the gap left by struggling businesses and shrinking international demand. The real trouble was in Germany's industrial sector, the backbone of its economy. Factories, once bustling with activity, are now facing tough times as orders from abroad dry up. Factories produced less than expected, directly linked to falling international orders. This slowdown has ripple effects impacting suppliers, workers, and entire communities that depend on manufacturing. When exports drop, factories cut shifts and slow production, dragging down GDP. Workers face reduced hours or even layoffs, adding to the sense of economic unease. The imbalance is clear: government spending is up, but private and export sectors are struggling. This creates a patchwork recovery, with some areas seeing growth while others lag behind. Relying too much on government stimulus isn't sustainable. Without a rebound in private investment and exports, long-term growth remains at risk. Germany faces the challenge of reigniting its traditional growth engines in a changing world. Innovation, green technology, and new markets could be key to recovery. The industrial slowdown is a symptom of deeper issues. Structural changes, global competition, and shifting demand are forcing Germany to adapt. The question is, can Germany turn things around and find a new path to prosperity in the face of these challenges? The German government isn't standing still. It's rolling out an investment booster package, making it easier for companies to write off new equipment and cutting corporate taxes. The goal encourages businesses to invest, expand, and hire. Berlin is also ramping up its own spending on defense and infrastructure, creating jobs and improving the country's long-term competitiveness. These measures are designed to counteract the sharp drop in business investment, but even officials admit more action may be needed. The Economy Ministry calls this just a first step, not a full solution. The debate now is how quickly and boldly to act. The government must balance stimulus with fiscal responsibility. The stakes for Germany's recovery couldn't be higher. Economists are sounding the alarm. Carsten Brzezinski of ING warns a substantial recovery before 2026 is unlikely. This downturn could last. Germany's export-heavy model is now a vulnerability, especially with global trade tensions and US tariffs. Other challenges loom: high energy costs, labor shortages, and the expensive shift to a green economy. Many experts doubt the current stimulus is enough to fix these deep-rooted problems. A third year of stagnation would be a historic setback. If pessimism spreads, it could become self-fulfilling. People spend less, businesses invest less, and the slowdown deepens. Germany needs bold, effective policies to break this cycle and restore confidence. Amid the gloom, there are glimmers of hope. The HCOB Flash Germany Composite PMI for August showed a slight uptick. Private sector activity may be stabilizing. Manufacturing orders are rising, hinting at recovering demand outside the US. If this trend holds, factory output could pick up in coming months. Policy responses are also helping. The European Central Bank is cutting interest rates, making borrowing cheaper. Combined with Germany's fiscal stimulus, this two-pronged approach could spark a moderate recovery. Economists say these steps may generate a modest pickup, but challenges remain. The structural issues and US tariffs are still real threats. Still, these positive signs suggest Germany's economy has underlying strengths. The road to recovery will be slow, but there's reason for cautious optimism. Germany's economic troubles are more than just numbers. They show how interconnected our world is. A US policy decision sent shockwaves through German factories, affecting workers and businesses. No major economy stands alone. Problems in Germany ripple across Europe and beyond. For Germans, a shrinking economy means job insecurity and pressure on public services. For the EU, Germany's slowdown drags down the whole region. Supply chains and trade are deeply linked. A weak Germany makes a strong Europe harder to achieve. The challenges Germany faces, trade disputes, energy transition, and aging workforce, are shared by many developed nations. Watching how Germany responds offers lessons for us all. Its recovery is a global story with consequences far beyond its borders. The world is watching, and what happens next matters to everyone.